Okay, hi everyone, Daryl here. Okay, so this is lesson 42 in my YouTube playlist Investing 101, and today we're going to talk about exchange rate risk. Okay, so what is exchange rate risk? It actually refers to the potential loss that an international financial transaction may incur when intercurrency fluctuations happen. Okay, so sometimes people refer to it as foreign exchange risk or currency risk and FX risk. Okay, so this risk is actually prevalent when investing in overseas equities or overseas properties. So if let's say like I'm in Singapore and then I want to buy maybe the Apple stock on the New York Stock Exchange, well, it will be on the Nasdaq. So I'm going to the US stock market and then I'm purchasing Apple stock, but I cannot use my Singapore dollar to purchase Apple stock. I have to convert my Singapore dollar to US dollar and then after that pay in US dollar to purchase Apple stock. So my Apple stock will always be denominated in US dollar. So there is a risk whereby uh, even if Apple stock stays constant, let's say I buy it at let's say 200 US dollars, and maybe 1 month down the road, right, Apple stock is still 200 US dollars. But the point is that if let's say the Singapore dollar um, became stronger against the US dollar, that means the US dollar weakened. So then against the Singapore dollar, then when I change back, if I sell the Apple stock at 200 US dollars, which is the price that I bought it, but when I change back to Singapore dollars, right, I can only change back a smaller amount of Singapore dollars as compared to previously when I had to pay that amount of Singapore dollars for that 200 US dollars to buy the Apple stock. So because of this fluctuation, whenever we invest in overseas assets, there's always this thing called exchange rate risk. Okay, and this is also the same when we are investing in overseas properties, and I will explain to you guys shortly in my next slide about an example that I have. Well, it's kind of like a situation. Okay, so there is always a potential for the base currency to appreciate or depreciate against another currency. So if you're buying equities or properties in a foreign country and you're paying in a foreign currency, then there's always a chance that the foreign currency may appreciate or depreciate against your currency. Okay, so this may actually exacerbate losses if the nominal value of the asset falls and the base currency appreciates against the currency in which the asset is traded against. Okay, so let me give you an example, right? Let's say you compare the UK property market. Okay, so if you know that, you guys should know that the UK is actually and like in a mess whereby they're trying to negotiate a way out of the European Union. So they're calling this thing called Brexit. And since Brexit, I mean, since the UK has actually voted to through a referendum to actually exit the European Union, the UK pound has actually steadily fallen against the Singapore dollar. And what happens is that there are a lot of people who, in the past, you guys would know that actually it would actually cost two plus Singapore dollars to purchase one UK pound. But currently, right, it's about I think it's about dollar sixty something to purchase one UK pound. So if let's say the Singapore property investor were to actually purchase a UK property, let's say maybe five to 10 years ago, they would have paid about $2 plus Sing dollar for one UK pound to purchase UK pound so that they could purchase the property. So what happens is that there are certain property markets in the UK whereby they've not been doing too well. So maybe property prices have fallen, maybe fallen marginally by maybe like 5% over the course of maybe the last 5 years. So what happens is that the Singapore investor who bought these properties, right, they not only lose 5%. When they sell the properties and realize the loss of 5%, they will receive UK pounds. So what they will do is that they will actually have to change UK pounds back to uh, Singapore dollars. And when they do that, right, they realize that they can't change back the same rate because pound has fallen significantly against the Singapore dollar. So that means that they could change back much less Singapore dollar for what they actually paid for the same amount of pounds. So if you are not careful when you invest in overseas assets like properties, not only may you lose money in terms of the nominal value of the asset in that currency, in the foreign currency, but because the foreign currency which you purchase the property from, right, may weaken against the Singapore dollar. Like from where I'm from Singapore, so may weaken against the Singapore dollar. Therefore, this may actually cause you to lose further amount of money in your own base currency. Okay, so another property market would be something like for example, I deal in Thai properties, and some of you guys know that I deal with Thai properties. So if you take a look at the Thai property market, for one reason or another has been very, very good to myself and maybe my property buyers. I would say that a little bit of foresight, but then I always believe that even when you invest, right, it takes a lot of luck to involve for everything to come together to make a decent amount of money. So if you guys know, right, actually the Thai property market has appreciated a large amount already, but because the Thai baht has appreciated against the Singapore dollar and against just about every other currency, any person who actually placed money in the Thai property market maybe 6-7 years ago, they not only would have made money from their property purchase if they sold their Thai property. Let's say they purchase it for about maybe 5 million Thai baht, okay, which works out in the past to be about 200 plus Singapore 200 plus thousand Singapore dollars. Okay, but now the Thai baht has appreciated. So there was a point in time where Thai baht you could purchase 25 Thai baht for every 1 Singapore dollar. But now 1 Singapore dollar will only get you about 22 point something Thai baht, which means that Thai baht appreciated about 10% against the Singapore dollar. So you're not only maybe getting 10% more in terms of Thai baht when you sell your Thai property, maybe your Thai property appreciated by, last time you bought for 5 million Thai baht, now maybe you can sell for 6 million Thai baht, so you appreciated 20%. But on top of this 20% increase, right, you also will profit from the exchange rate, because once you receive Thai baht, you will sell the Thai baht for Singapore dollars, and you can change more Singapore dollars than as compared to previously when you use Singapore dollars to buy Thai baht. Okay, so this is uh, like 2 times the gain. Okay, but then of course if it goes against you in the other direction, right, then it's 2 times the losses, because you lose money one time in terms of the nominal value of the asset of the foreign asset, and after that the value of the foreign asset, and then you lose again in the exchange rate. Okay, so you can lose twice, you can also gain twice. Okay, so this actually means that when we are investing in foreign assets, like if you're a Singaporean and then you are investing in like maybe the US stock market, or you're investing in a UK property, or you're investing in a Thai property, then you need to be very sure, or not say be very sure, but you need to be aware of the exchange rate risk on top of just whether the property price goes up or down. Okay, so that's all from me for this week, and I'll see you in the next video. See ya.